Welcome to Wealth Blueprint, where we provide research-based analysis and insights on dividend investing and passive income strategies. Today, we're going to discuss the common pitfalls of dividend investing and how to avoid them. Research shows that dividend investing can be a powerful tool for building wealth, but it's essential to approach it with a solid understanding of the underlying principles. According to BLS data, the average household earning $100,000 per year can benefit significantly from dividend investing. Per IRS publication 590, dividend income is taxable, but with the right strategy, you can minimize your tax liability. For instance, let's consider a scenario where a household earning $120,000 per year invests $500 per month in a dividend-paying ETF with a 7% annual return over 30 years. The compounding effect can lead to significant wealth accumulation, with a total value of over $1 million. This example illustrates the potential of dividend investing, but it's crucial to avoid common mistakes that can hinder your progress. The Federal Reserve survey shows that dividend-paying stocks have historically outperformed non-dividend-paying stocks. However, it's crucial to avoid common mistakes such as over-concentrating in a particular sector. For example, the S&P 500 tech weight is approximately 28%, and overexposure to this sector can lead to significant losses. To put this into perspective, consider the dot-com bubble of 2000, where the tech sector experienced a massive decline, resulting in significant losses for investors who were overexposed to this sector. Our analysis of specific ETFs such as VOO, JEPI, and VYM will provide you with a deeper understanding of the dividend investing landscape. With expense ratios ranging from 0.03% to 0.35%, it's essential to choose the right ETF for your portfolio. For example, VOO has an expense ratio of 0.03%, whilst has an expense ratio of 0.06%. These differences may seem minor, but they can add up over time, affecting your overall returns. We'll also be discussing the importance of diversification and how to avoid common mistakes such as chasing high dividend yields. Studies suggest that a well-diversified portfolio with a mix of low-cost index funds and dividend-paying stocks can provide a stable source of income and long-term growth. According to a study by Vanguard, diversified portfolio with a mix of 60% stocks and 40% bonds can provide a stable source of income and growth, while minimizing risk. The research shows that dividend investing can be a powerful tool for building wealth, but it's essential to approach it with a solid understanding of the underlying principles. By avoiding common mistakes and choosing the right strategy, you can unlock the full potential of dividend investing. As Warren Buffett once said, "Price is what you pay, value is what you get." This quote highlights the importance of understanding the underlying value of your investments rather than just focusing on the price. For example, the current dividend yield is approximately 3.5%, while VYM has a dividend yield of around 2.9%. These numbers are subject to change, but they provide a good starting point for your research. However, it's essential to look beyond the dividend yield and consider other factors such as the company's financial health, growth prospects, and industry trends. In addition to choosing the right ETF, it's essential to consider the sector concentration of your portfolio. According to the S&P 500, the tech sector accounts for approximately 28% of the total market capitalization. Overexposure to this sector can lead to significant losses, so it's essential to diversify your portfolio. For instance, you can consider allocating a portion of your portfolio to other sectors such as healthcare, finance, or consumer staples. We analyzed the historical performance of VOO, JEPI, and VIM, and the results are promising. With a long-term perspective, these ETFs can provide a stable source of income and growth. However, it's essential to remember that past performance is not a guarantee of future results. As the saying goes, past performance is not indicative of future results. It's crucial to stay informed and adapt to changing market conditions. Further illustrate the importance of diversification, let's consider a case study of a portfolio that was overexposed to the energy sector in 2014. When the oil prices declined, the portfolio experienced significant losses. In contrast, a diversified portfolio with a mix of low-cost index funds and dividend-paying stocks was able to weather the storm and provide a stable source of income and growth. In conclusion, dividend investing can be a powerful tool for building wealth, but it's essential to approach it with a solid understanding of the underlying principles. By avoiding common mistakes and choosing the right strategy, you can unlock the full potential of dividend investing. As billionaire investor Ray Dalio once said, "The most important thing is to have a clear understanding of what you're doing and why you're doing it." This quote highlights the importance of having a clear investment strategy. and understanding the underlying principles of dividend investing. If this video has provided you with valuable insights and information, hit subscribe. We're covering the topic of tax-efficient investing in our next video, dropping soon. Ring the bell so you don't miss it. What's your biggest takeaway from this video? Stay informed. See you in the next breakdown. Additionally, we'll be discussing the importance of tax-efficient investing in our next video. According to a study by Morningstar, tax-efficient investing can save you up to 5% in taxes per year, depending on your tax bracket and investment strategy. This can add up to significant savings over time, and it's essential to consider tax efficiency when building your investment portfolio. In our next video, we'll be discussing the top tax-efficient investing strategies, including tax loss harvesting, charitable giving, and tax-deferred accounts. We'll also be providing tips and tricks for minimizing your tax liability and maximizing your returns. So, be sure to hit subscribe and ring the bell to stay informed and up to date on the latest investing strategies and trends. Furthermore, we'll be exploring the world of real estate investing and how it can be used to generate passive income and build wealth. According to a study by the National Association of Realtors, real estate investing can provide a stable source of income and growth, with average annual returns of around 8–10%. However, it's essential to approach real estate investing with caution and do your due diligence, as it can be a complex and nuanced field. In our upcoming video, we'll be discussing the top real estate investing strategies, including rental properties, real estate investment trusts, REIT, and real estate crowdfunding. We'll also be providing tips and tricks for getting started with real estate investing, including how to find the right properties, how to finance your investments, and how to manage your portfolio. In the meantime, we recommend that you do your own research and due diligence, and consider consulting with a financial advisor or investment professional before making any investment decisions. It's essential to have a clear understanding of your investment goals and risk tolerance, and to develop a well-diversified